Welcome to the Value Investor TV podcast. My name is Becco and my partner,
Ari.
And this is the podcast that helps you become financially independent and grow your wealth. All right, let's get started. This is the episode 54, and we are covering the second part of Levi Strauss. We're going to go into the financials, the management, and lastly, the valuation.
Yeah, let's do a quick disclaimer here.
Yeah,
we are a podcast that's focuses on helping you grow or educate you on how to invest like value investors do. To that end, we are not your financial advisor. We are trying to help with your education. So we don't know your financial situation or your or anything really about your setup or your understanding of the companies that we talk about. So do your own research, do your own investing, and make those decisions for yourself. If necessary, contact your own financial advisor.
That's a good one. That's a very pointed disclaimer right there.
That's what I'm here for.
All right, let's get into this.
Let's talk about the importance of the moat that we saw. The brand moat was what we kind of identified was really their only way to keep the barbarians off out from breaching their castle.
Mm-hmm.
So are they able to take that moat and make good returns on it is the question.
Right. So that's captured by return on equity, or return on invested capital, return on capital employed, these different ratios. So let's take a look at that. Return on equity, it's painting a kind of deceiving picture if you look at return on equity.
Yeah.
So if you look at 2018 number, it's 42%, 43%.
Which would normally be very eye-opening.
It would be a great company if that was the case. But you have to dig a little deeper. So that's why you have to look at multiple numbers. If you look, return on equity, if you look at the formula, it's return on equity. Equity, you take away
assets minus liability is equal to equity.
Yeah. So if your liability is huge, your equity is going to be relatively small. So the percentage of revenue divided by a small number is going to be big.
Right.
And so this number is pretty much artificially inflated when you have a lot of debt.
Yeah. So how do we, if we want to avoid just using the one number, how do you look at it from other ratios?
So you look at, capital employed.
Yeah.
Or capital, return on capital employed, or return on capital invested. You would look at it that way.
Okay. So what are those look like?
So if you look at capital employed, it's around 11%, 11 to 10%. And that number has steadily climbed up starting from, let's see, about 10 years ago, really.
Yeah. So that number is actually, instead of using net income for capital employed, we use the EBIT. So that's operating income. In most cases, are equal to EBIT, and it's a slightly different calculation for on the asset side. So it's total assets minus
current liabilities. Yeah, exactly.
So excuse me, and then return on invested capital is assets plus plus liabilities.
Yeah.
So
yeah, exactly. So if you look at that number, it is not great. It has gone up, but it's not great.
Right.
And that kind of translates back to what we talked about earlier, which is their moat, right?
Yeah.
The lack of moat itself translates into the low numbers in return on equity or return on invested capital.
Correct. Yeah. So, excuse me. I think one of the things that you're seeing here is this is a company that's trying to kind of shore up its own balance sheet. So you're seeing a kind of an adjustment here of that. So that's why, from 2011, when the new management took over, their return on capital employed has steadily climbed because their operating income has climbed. The return on equity has actually decreased because they've paid off some of their debt.
Mm-hmm.
Right? They were highly leveraged before. They had almost $2 billion in debt. They've cut that into by half now. So, there's some interesting things going on here. But as far as are are they translating this into a high return on capital? I think the answer is undecided at this point. Right?
Yeah. And also, I think this is important to point out that we as value investors, retail value investors, we have the entire universe to look after.
Yeah.
So you don't really have to look at only retail stocks.
Right.
It may be in the charter for some institutional investors. We don't have any charter.
Yeah.
So we can look at anything.
Right.
And if you're getting return on invested capital of, let's say, generously 10%,
right,
and you can get 30 or 40% elsewhere,
yeah,
you're going to go there.
Yeah, and as the way Warren Buffett talks about this is that the opportunity cost here is if I can get a company that's returning 18%, that's my floor, right? Everything has to beat that, right? Otherwise, it's not interesting. Mm-hmm. And so, the opportunity cost here is that there are, banks out there that give you that kind of return, mm-hmm. and they're very easy to kind of assess, right? And so, why should I even look any further, right? If I'm looking at a company with a return on capital that's, below 15% here. Yep. So for right now, I would say, we'll continue the exercise of going down,
sure,
to look at it. But I'm not thrilled with where, their kind of their structure of their financing right now.
Yep.
So do they have enough cash to maintain their business? And I think it's important to note the S1 filing that we are using to review, they also received a bunch of cash as part of the IPO, and it's not reflected in the balance sheet as we talk about it now. Mm-hmm. So, what does the cash picture look like?
Yeah, I want to point this out because I think this is really interesting. If you look at, when we look at debt to equity ratio, starting from, let's say, 2013, mm-hmm. debt to equity ratio was like 9.
Yeah.
Right? That's pretty high.
Lower than 1 is what I want to see.
And it's 9.
Yeah.
And, that's pretty up there.
Right.
And successfully they've gotten that number down to 1.5, 1.6 as of 2018. Now that now
it'll be much lower because they've got more cash in. So
right. But they're putting this, they're trying to get this under control. But still there is this outstanding issue of debt. Right. And they talk about that. They talk about that in the annual report itself too. They said, all these big liabilities are coming up, and we want to be able to manage that. And they do say it. They do say it, going back to kind of the honest management aspect of it. They do say that this is a problem when you want to invest in this company. Yeah. which is good.
Yeah, it's reasonable to be worried about that. They should have enough cash now to cover all of that. And we have to remember that the way they report operating leases will change this year. So in these retail companies, you have a lot of them are renting their stores. That is not considered debt. Depending on how you look at it, it's not considered long-term debt. For the debt to equity ratio, they are. I think the GAAP rules are now going to be changing to account for that if they haven't already. So, what you're seeing right now is the debt to equity ratio being, may adjust because they have operating leases that are, and the thing about the operating leases, you can still break them. Mm-hmm. You don't have to pay out the entire amount, even though, depending on, but you need to look into the footnotes of the company to understand that. So, all right. So we've talked about cash and debt. What about their cash flow, free cash flow from operations? Is that enough to continue the business?
Yeah, I think, especially in the light of debt, I think your rule of thumb is 3 times free cash flow for debt. So you want to have less than 3 times free cash flow in your balance sheet for debt.
Right.
And if you look at free cash flow, you're getting about 400 million. Right. Sorry, about 400 million. Let's just put it roughly. And then the debt itself, it's $1 billion.
Yeah.
So it's like right, at that threshold.
Right. And now that they have IPO'd, they have more cash available to them. Yeah. So I think that'll help them pay down some of that. So I'm less concerned than I was. Yeah. I think the IPO was actually probably to reduce this debt burden in some ways. They obviously also for growth and other things, but to help pay down the debt without having to take on further, obligations.
Yeah,
so
exactly.
Okay. So we kind of mentioned in the first half in part one about management. There were some things about honesty and openness that we were a little bit frustrated with in the way they presented the annual report. But let's talk about that. Is management properly incentivized to protect shareholders' interests? So
I looked into their compensation plan and what they have to achieve to get full compensation. And like many other companies, their biggest performance is pegged on EBIT.
Yep.
So if they can achieve a certain level of EBIT, they're getting 50%. They're getting performance bonus of. Let's say the performance bonus is 100%. 50% of that is based on EBIT number.
Yeah.
25% of that is based on sales inventory, and the other 25% is based on net revenue. That's how this is structured.
Yeah, so that's kind of interesting, right? It's good that they have EBIT as a target, right? I don't know why you would do EBIT and net revenues, right? They're kind of tied together in some ways. Obviously, they're trying to focus their management on profitably growing their revenue, but why not just make it all EBIT is the way I would say.
Yeah.
What does revenue give you that EBIT doesn't in that case?
Yeah, I think if you look at the kind of the target for 2017, I pulled this from 2017 annual report. The company's target for compounded growth rate for net revenue goal for 2017 was 1%. 1%. And then the average margin of net earnings goal was 11.9%. So maybe they're talking about the net margin rate, for the EBIT, and then the growth is measured by the sales growth rate.
Yeah, well, I think depending on what the targets are, they haven't done a very good job of this. Their net revenues have grown at 2% a year, right? Since management took over, which is not good. That's not that's
inflation.
Inflation, essentially. So, they just raising prices by 2% a year is essentially what that's doing. So, frankly, that's the management hasn't shown me anything here that's excites me, right? In terms of that, and it may not be that management is able to, right? This is a business that's 150 years old, and everybody knows about. Their growth is not going to come from new people coming in, which is the most reliable form of growth. So they have to get a lot more creative, which is why they're trying to focus on tops and these other things. Women's apparel. So, okay, so how has management handled excess capital in a shareholder-friendly way, or have they? They've mentioned. Have they mentioned anything about share buybacks or dividends?
So if I look at their cash flow statement, the stock repurchase program has been in place for a little while, but it's definitely not enough to make a dent in the EPS number there. And when you look at dividends, they've definitely been paying out some dividends for a long time. I think that kind of speaks to, like we said, the late stage of the company's cycle, because there isn't. I think the intellectually honest thing to do when you are faced with a situation where there is no room to grow and it's very difficult to grow is to give it back to shareholders.
Right.
And we're seeing some signs of that here.
Yeah, but I would also say, in the context of paying out a dividend, right? I'm opposed to dividends in almost every situation, right? I don't need to be taxed again on the same thing. And, the argument that a retirement portfolio should be full of dividends, I'm like, just sell the stock if it's, I'd much rather have a stock growing at 25% a year than a 3% dividend. Who the hell cares about a 3% dividend? I can just sell 3% of the stock if I need it, right? I think it's and
you're going to be taxed at a lower rate.
And I'll be taxed at a lower rate. So, and if it's in my retirement account, I won't be taxed at all. So, I'm not entirely enamored with the idea that dividends are like this, virtuous thing that needs to be kept, right? Like that it protects, it doesn't do any of that. In practice, share buybacks should be, and also if you went IPO just to get money, why are you paying a dividend then? Why don't you pay down your debt?
Yeah.
Get rid of this interest expense that I have to worry about, and then buy back your shares.
Yeah.
Right. This is, if it sounds like I'm being harsh about this, I'm looking at this from if I'm a shareholder in this company, what am I getting out of owning this stock? Right. I'm getting nothing really. That my share is going to generate, relative to the current price that I would pay, which we'll talk about in a second, fairly low rate of return. Earnings yield, which is the earnings per share divided by the price, is very low relative to other companies. So, and the free cash flow is not really exciting or growing.
Yeah.
So what's in this for me at this point?
Yeah. That's, again, I think this is one of the things that you talked about when we first met and started to talk about stocks, is that the world doesn't care if you own Levi's. The world doesn't care if you own Tesla.
Right.
The only thing that you should care about is how much money can you get from owning a business.
Right.
Right.
Yeah.
The feel good about, I own Levi's because it's a classic American brand. It doesn't really. It might suit you well for a couple of days. You might have the. You could probably go around and tell people that I own Levi's, but at the end of the day, money is really what matters in this game, and if you're not getting that, it's kind of meaningless.
Well, I mean, businesses exist to make a profit for their investors, right? That is the only thing that they do. And so I'm going to look at this and say, what is the opportunity cost for me owning Levi's versus, say, another company, right? And I would say it's pretty high, right? I mean, it's going to be expensive for me to own this.
It is going to be very expensive.
Because I could potentially buy something with higher return on capital, higher runway for growth, higher everything, right? Better shareholder, management. If they were a share price cannibal, I'd be a little bit more interested in this, right? Taking that free cash flow and buying back a ton of their shares, a lot more interested. So now that we've thoroughly blasted their management and everything else about this, let's talk about the valuation so that we can kind of see why we're not so enamored of it.
Yeah, let's take a look. So with initial cash flow of $381 million, and we're assuming a growth rate about 5% for the first 3 years,
which is generous considering the last 7 years have been 2.5%.
Exactly, and their company's growth target, right? The company's growth target is like 1%.
Yeah.
So 5% is quite generous, and then we say 3% and 2%. So 5% for the first 3 years. The next 3 years is about 3%, and the next is about 2%. That's the growth rate we're assuming. And of course, the discount rate, we're here in the podcast, we always do 10% because that's our minimal threshold.
Right.
And there's number of shares outstanding, about 370 million shares, and then debt level. This is all before S1 filing. So this is all this number that we're talking about is before the new IPO.
Yep.
And add back the cash, we get $7.48 per share.
Yeah, and they're trading at around $22 to $23 right now. So, I mean, they're overvalued by quite a bit.
Quite a bit, yeah.
And I think, ironically, as you looked at, when we did all of this, the intrinsic value is about 10 times their earnings per share, right? Which is roughly where it comes down to. If you want a margin of safety, you still have to get this at even lower price, right? Yeah. So, I mean, with a low grower like this, I would want a price to earnings ratio of like 5 or 6, right? Which is what if we bought this as a private company, that's how much the private company transaction would be.
Yeah.
On a public market, they're trading at 30 times earnings now. This is an expensive stock, right?
Yeah. It's very expensive stock for sure.
And here's the funny thing about this: at that price, their share buybacks could be very meaningful, right? They could buy back a ton of the company
at this price.
No, at closer to their intrinsic value.
Oh, yes.
Right?
Yeah,
and it would be a lot more meaningful use of their capital, right?
For sure.
Cut their dividend, get rid of all of this other...
just pay down the debt, really.
Yeah, pay down the debt, and then hoard your cash, and then if the price drops, you just buy a ton of the shares.
Yeah.
And then, retire them, right? I think that's the way to put value back into the shareholders, right? Which is your only job, right? As the CEO and, the board of this company is to look out for shareholder interest, is to do that. So
yeah, I think that's a really sound strategy. I think, especially when we talk about late stage company like this, I think that's what you should be doing.
Right.
Hoarding cash, paying down the debt. And when the moment comes, buy a whole bunch of, retire a whole bunch of your shares.
Yeah.
And return that value back to your shareholders. I think also what is interesting about the IPO, the timing of the IPO is quite interesting, right?
Yeah.
The stock market is, some might say all time high. Bull is, is at its pitch high fever, and they're going in and IPOing at this incredibly rich valuation. I mean, to me, props to them because they're taking advantage of the incredible valuation because they're getting a lot of money for what they have.
Right.
But I think it's up to them to be a better steward of that capital for shareholders.
Yeah, and I think what I would say is a lot of people have this idea that you buy great businesses, right? Warren Buffett says this all the time: buy a great business, and time is your friend, right? It'll grow into it. But a great brand does not necessarily make it a great business, right? And which is what we're seeing here. I think we all agree Levi's is a fantastic brand, but as a business, they're not a great business, right? And so what we want out of everything is a great business, and that comes from, actually doing the analysis, right? So this is a discussion that we've, if you read Peter Lynch, Peter Lynch always says, buy what you know, right? He never says, but people interpret him as saying, if it's good, if you buy it, just go buy the stock.
Yeah.
That's not what he says, but that's what people do when they read his book. For whatever reason, I don't understand why. He always says that's where you start looking, right? So we looked at this as, I own a pair of Levi's, multiple pairs. You own multiple pairs. Probably almost everyone
Pretty
has.
much everybody, yeah.
So it sounds like a good place to look, right? We fly Southwest Airlines all the time, so it's a good place to look. And what we find is Southwest is a great business, right? They're run very well. Levi's is a great brand, but not necessarily a great business.
Yeah.
So that's why it's good. Peter Lynch is a genius, right? If you're going to listen to what he says, it's important to understand it's not where you stop, right? When you see the great brand, it doesn't stop there. You have to investigate further.
Yeah.
Right?
I think that's a really good point. That's a really good point. Differentiating brand versus the actual, operating functioning company.
Yeah.
Yeah. Definitely a good lesson to take away.
Yeah. I think you could say like Toys R Us was a fantastic brand, right? The people who ran that company into the ground were terrible operators, right? They literally had a cash cow, and then they just loaded it up with debt and destroyed it, right? And that's, it looked like Levi's had a similar trajectory.
Yeah.
If they didn't do this, they are doing this to sustain the business, which I fully respect. But now you pay down that debt, you have an obligation to fix. What is the incentive to buy a company that has no growth and no real, future, growth that I can see from what they've told us? What are you going to do now, right? So
I think these practices that you mentioned, loading up a debt. Levi's had the similar problem with debt problem as well, and anemic growth.
Yeah,
I think a lot of that has to do with like really short-termism, right? You load it up with debt, and then all of a sudden you have this cash, and then you can just infuse it right into the business without really thinking about the long-term consequences of that.
Right.
And as shareholders, as investors, we need to be very mindful of companies like that.
Yeah.
Yeah.
There's certainly a lot of them.
Yeah. Awesome. I think that was a good exercise into investigating Levi's and some really good lessons to take away from, like Hari mentioned. All right. Anything else you want to mention before we close this one out, Hari?
We went through our checklist. if you need to get a copy of the checklist, you can email us at info@valueinvestor.org or follow us on Twitter at ValueInvestorTV, and you can direct message us or to ask for that checklist. We're happy to send it over to you. Or if you have any companies that you want us to talk about, we're happy to take them into consideration. And also, if you have any questions, every once in a while we do a question podcast. So send us your questions. We'll accumulate them, and then we can do a podcast just focused on the questions.
Awesome. Well, that's it for us. Episode 54, guys. Thank you all for listening, and see you guys on the next episode.
Thanks.